Late last night, a heavy cargo aircraft reportedly lifted off from Maiquetía Airport, outside Caracas. According to multiple open source flight trackers, the plane's behavior looked unusual. A limited filed route, then a transponder signal that appeared to go dark after it reached international airspace. A few hours later, separate tracking feeds showed a matching aircraft signature reappearing far to the east, consistent with a landing window in or near Beijing. Now, let me be careful with the language here. We do not have a public bill of lading, we do not have an official customs declaration, and we do not have a government press conference confirming what was inside the cargo hold. But we do have a pattern analysts watch closely. When high-value state assets move in a hurry, the logistics look different. The security posture changes, the routing gets strange, and the public narrative goes quiet. So the question is simple: what was on that flight? And why does it matter for the global silver market? This is Global Money Alert. What changed, who it hits, and what to watch next. If you want calm, clear updates like this during fast-moving market weeks, hit subscribe. I post Global Money Alerts when the signals change, not when the headlines catch up. Now here's the core thesis of today's report. If the tracking interpretation is accurate, Venezuela may have just moved a meaningful quantity of precious metals, gold, silver, or both, out of its domestic control and into an allied jurisdiction in Asia. Not as a normal commodity sale, but as an emergency relocation of national wealth. A get-it-out-now move. And whether you love that idea or hate it, the market implications are real because physical metal moves differently than paper. Paper contracts can be created with a keystroke. Physical cargo requires trucks, guards, forklifts, flight clearances, fuel stops, and quiet agreements between governments. That's why, when physical moves at state scale, it often signals stress, not always war, sometimes sanctions pressure, sometimes debt pressure, sometimes internal political risk, but stress, reset. Now, why would Venezuela do something like this? The country has lived under sanctions pressure for years. In that environment, assets held in the Western financial system can face restrictions, frozen accounts, blocked transactions, seized reserves, and legal battles that drag on. If you are a government under pressure, you learn one brutal lesson fast. What you don't physically control can be delayed, disputed, or neutralized. So if Venezuelan officials believe further escalation is possible, more sanctions, tighter enforcement, or a security crisis, the incentive becomes to move hard assets to a place where they think those assets are less reachable. And in today's world, the destination that comes up again and again in these conversations is China. Not because China is good or bad in some moral sense, because China is powerful, strategically hungry for commodities, and willing to settle outside the traditional dollar-centric rails. That brings us to silver. Why silver specifically keeps showing up in global strategy. Silver is not just a coin shop metal. Silver is a strategic industrial input. It's used in electronics, in solar, in medical applications, in high-reliability components, and in advanced systems where conductivity and durability matter. It's not easily substituted at scale without trade-offs. That's why silver is one of those markets where physical tightness can arrive quietly and then show up suddenly in premiums and availability. And China in particular has a reason to care. China is a dominant player in global manufacturing and solar supply chains. If a state actor can acquire physical silver directly, especially at distressed pricing from a nation under pressure, that's not just buying metal. That's securing supply. Quick question. Do you think countries will keep moving toward physical settlement to reduce sanctions risk? Type 1 if you think yes, type 0 if you think no. I read the comments because it helps decide what I cover next. Reset. Now, some people will ask, is this just another rumor? Here's my standard rule. Don't treat one flight as proof of an entire monetary reset, but also don't ignore the direction of travel in the world. More trade is being conducted using alternatives to traditional dollar routing, local currency settlement, barter-style deals, commodity-linked arrangements, not because the dollar disappears overnight, but because sanctions risk makes dependence on one system dangerous for certain countries. When access to a payment system can be cut off, countries that fear being targeted start looking for sanction-proof settlement methods. Physical commodities are the oldest form of sanction-proof settlement. You can block a wire transfer. You cannot freeze a pallet of metal that has already moved. That's why this matters. Let me add context. Venezuela has been linked to precious metal logistics before. In past years, researchers pointed to episodes where gold was exported or moved through non-traditional channels during periods of intense pressure. The reason those stories mattered is not gossip, it's the incentive. When your access to dollars is constrained and reserves are contested, hard assets become bargaining chips. And in a sanctions world, commerce doesn't stop. It reroutes through intermediaries, swaps, and resources for services deals. If the stakes rise, the logistics can look deliberately hard to interrupt. So why Beijing? Because a government under pressure looks for a counterpart with deep vault capacity, willingness to settle outside Western rails, and geopolitical interest in the relationship. China fits that profile for many countries, not out of charity, but strategy. Now, does this mean the aircraft definitely carried bullion? We can't confirm that from trackers alone, but analysts watch tells: unusual routing, timing near political events, heavier security posture, and dense cargo profiles consistent with metal rather than ordinary freight. The smart way to frame this is probability. If it was metal, then these consequences follow. Reset. Now connect it to the dollar. Countries explore alternative settlement methods for one simple reason. The dollar system is efficient, but it isn't neutral. If you can be cut off, you are not fully sovereign in payments. That creates a parallel economy at the edges, reducing dollar necessity trade by trade. Small reductions matter when repeated. One more point: trust and repatriation. When countries watch others lose access to reserves held abroad, they ask, could that happen to us? If the answer is maybe, then moving gold and silver home, or to a friendlier jurisdiction, starts to look rational. If this story is later verified, expect more quiet repatriation and more strategic stockpiling. Finally, the market impact paradox. A major physical movement can happen with minimal spot reaction because spot is dominated by paper flow. Physical tightness often shows up first in premiums and delivery times, and only later in the headline price. So here are 3 clean takeaways. First, sovereign metal moves are geopolitical signals. Second, physical flows hit availability before they hit the chart. Third, confirmation will show up in premiums, delivery, and institutional language, not just online noise, because it suggests a state-level shift from paper claims to physical control. Reset. Now let's talk about scale, because the physical market is not infinite. Even a few hundred tons of silver sounds abstract, but the silver market is smaller than most people realize once you remove what's already locked into industrial pipelines and long-term holdings. When large buyers move, the market doesn't always react instantly on the spot screen, because spot is largely a paper reference rate. The first place you feel physical stress is not in the chart, it's in availability, it's in delivery delays, it's in premiums, it's in wholesalers telling dealers, we can't quote that size right now, so if you're watching for confirmation, don't only stare at the price ticker, watch the plumbing, spreads between paper and physical, lease rates, delivery times, retail premiums. Those are the stress gauges. Now, some commentary online claims these types of flights are linked to heightened security or contractor involvement. I can't verify specific actors. The important point is simpler. If the cargo is valuable, the security posture will match. If it's just spare parts, you don't need secrecy and urgency. If it's bullion, you do. Now let's bring this back to you, because you might be thinking, what does Venezuela have to do with my life? It matters because physical silver is global. Every ounce removed from open supply changes the competition between the remaining buyers. And those buyers are not just coin collectors, they are manufacturers. They are national stockpiles. They are financial institutions adjusting collateral quality. And they are households hedging against currency erosion. In a tight market, you don't need everyone to buy. You only need a few large entities to compete at the same time. And if sovereigns are moving first, that's information. Reset. Now, there's a part of this story that gets almost no attention. Strategic supply chains. Silver is used in advanced systems. It's not the only material that matters, but it matters. And in a world where supply chains are increasingly geopolitical, stockpiling inputs can be seen as preparedness. You can print money. You cannot print raw materials. So when a large country secures commodities through state-level channels, it's not just investment, it's resilience. Now, what about the claim that the spot price barely moved? That can happen because spot is a reference built around paper trading venues. A physical transfer that happens as a state-to-state arrangement can occur completely off-screen. It doesn't need to touch a public exchange, and that's a useful reminder. Price discovery is a mechanism. If the mechanism is dominated by paper flow, then physical flow can be under-reflected until physical tightness forces the mechanism to adjust. That adjustment often shows up first in spreads and premiums, and later in the headline price. So what should you watch next? Here are 5 signals. 1. Do retail premiums rise even on calm price days? 2. Do wholesalers tighten allocations or extend delivery times? 3. Do you see unusual import-export data in the weeks ahead once paperwork catches up? 4. Do officials or large institutions begin to talk more openly about commodity settlement? And 5. Does geopolitical tension accelerate in the next 30 days? Because moving national wealth quietly often implies someone expects trouble. Again, not proof, but signal. Here's the practical angle, without hype. If you only watch spot price, you can miss the first phase of tightening. That phase shows up as out of stock, higher premiums, and dealers limiting quantities. Later, industrial buyers pay up for guaranteed delivery, and only after that does the paper price catch up. So stay grounded. Track physical availability where you live, track delivery times, track the gap between what you can actually buy and the screen price. If that gap widens for weeks, physical is pulling away from paper. And one last reminder, don't let urgency replace standards. Wait for follow-on evidence, shipping data, official statements, or credible investigative reporting before treating this as confirmed. But also recognize that markets price probabilities, not certainties. When enough participants believe a physical shift is underway, they change behavior, and that behavior itself can tighten supply, reset. Now, the script ends with a warning about tighter controls in the West. Historically, when governments feel currency pressure, they do attempt controls on transfers, reporting requirements, and certain asset flows. You don't need to be alarmist to accept that systems protect themselves. That's why people who care about hard assets talk about timing and jurisdiction, because rules can change. So here's the takeaway. Even if you set aside sensational headlines, the underlying lesson is solid. Physical possession is different from paper exposure. Jurisdiction matters. Settlement methods are evolving, and competition for strategic commodities is intensifying. If this flight story is accurate, it's not just a Venezuela event. It's one frame in a longer film. Value moving through physical channels because trust in paper systems is being stress tested by geopolitics. So don't watch only the spot price. Watch premiums, watch delivery times, watch inventory signals, because physical stress shows up there first. Type 1, if you think sovereign commodity settlement is accelerating. Type 0, if you think this is mostly noise. And comment your country, USA, UK, Canada, Australia, EU, or other. Next video, I'll show you how to track physical market tightness without hype. What data matters, what doesn't, and how to spot a real squeeze early. This is Global Money Alert. Subscribe for the next update.